Welcome to Module 25 of Accounting 5000. In Module 25, we're going to continue with Chapter 13. We're going to talk about 4 basic items in this module. We're going to talk about overhead and how we use overhead to be included in the cost of a product. We're going to talk about the cost of goods manufactured statement, the cost of goods sold statement, and ABC costing. So let's start out by talking first about overhead, because that continues with what we were discussing at the end of the last module. Remember, we said there were 3 costs in any product: direct labor, direct materials, and manufacturing overhead. We know the cost of our labor, we know the cost of our materials, because we can track those as we enter them into the production process. So at any point in time, we can figure out what the cost of a product is from a materials and labor viewpoint, but the overhead is a little bit different problem, because a lot of our overhead costs only occur, say, once a year if we're talking about taxes or insurance, perhaps just once a month if we're talking about electricity. So we have to somehow put the overhead costs onto the items that we're producing so that we can have a good idea of what it's costing us to make that product, so we know what to sell it for. So the way we go about assigning overhead costs is by using what we call a predetermined overhead rate. We apply our overhead to our production as the production occurs. Now remember, these are all estimates, so we could be off a little bit. But this is how we go about putting a cost for overhead onto a product. Since we assume that all of our products are being made, all of our overhead costs are being incurred. So what we do first is we estimate what our overhead for the whole year is going to be. Again, it's a guess. What is our total overhead? Electricity, depreciation, taxes, and so on. What is it going to be? Then we determine a base on how we're going to apply that overhead. We have to have some way to take that overhead and divide it up so that we can assign it to the products we're making. The most common ones are the 3 that you see listed there in the second bullet. Sometimes we use direct labor hours, sometimes we use direct labor dollars, and sometimes we use machine hours. Again, it's just determined by what our particular process is. What is it? Which machine related? Is it labor related? What is the driver? What's the cost that's making that work? What's the cost we need to add to that product? So what we do is we take our total overhead cost, we divide it by direct labor hours, direct labor dollars, whatever our driver is going to be, and we come up a dollar amount or a percentage amount that we're going to apply to our products. Now we may be over or under, because remember, we're talking about an estimate here. The overhead could be, let's say, like in the first bullet, $6 per machine hour. Well, if we work more machine hours than we planned, we will have applied more overhead than we actually incurred. So we will have then what we call over-applied overhead. The reverse can also be true. If we don't work our machines as much as we expect to, we could have under-applied overhead because we haven't put enough dollars onto the cost of our products. So we call that over and under-applied overhead. It's simply the difference between what we actually had in our overhead costs and how much we applied using that base during the year. The differences between actual and applied overhead are usually not very significant. Companies get very good at estimating their overhead. They get very good at estimating the base, so they're usually within a margin of error on the over or under applied overhead. If it's insignificant, if it's not a material amount of money, we simply close it out to cost of goods sold. If, however, it's a major amount of money, we've vastly missed our guesses, then what we need to do then is divide up the cost between work in process, finished goods, and our cost of goods sold. So we'll have to allocate the over or under applied overhead against the various products to which that overhead should have been assigned originally, but which we made a mistake on. But usually, like I said, most companies don't miss it by much, so they may be over or under applied by a small amount, but usually it's not significant or material. So what you have now are 3 costs. You have your materials, you have your labor, and you have your overhead. So you have the 3 costs of making a product. Now the way we go about in accounting showing these 3 costs is by putting together what we call a cost of goods manufactured statement. Cost of goods manufactured statement lists the cost of materials, the cost of the labor, the overhead, and then it adjusts for what we call work in process. Because remember, some of our products were started, not finished, so we have a process that has not been completed. We still need to account for that. So if you're looking at a statement of cost of goods manufactured, remember that we're going to have what we call a beginning work in process. In other words, when we walked in January the 1st, there was some work sitting there that we hadn't finished last year. So the first thing we're going to do is finish up that leftover work. Then when we leave at the end of January, there's going to be some work we've started but hadn't finished. And that's going to be what we call our ending work in process inventory. So there's stuff we've got to finish up, and there's stuff we start that we haven't finished yet. Those are our beginning and ending work in process inventories. So we just take our raw materials, our labor, our overhead, and our two finished work in process inventories, and this, what you see in front of you, becomes the statement of cost of goods manufactured. Notice in the first area, we actually have to compute how much the raw materials were. We take our beginning inventory and add all the purchases of raw materials. That tell us how many raw materials we had available. And either we used them or they're still there, so we go in and count what's still there, and we figured we used the rest of them. So that's our raw materials used. We add to that our direct labor, our manufacturing overhead that we applied for the month, and that gives us our total manufacturing cost for the month. We add to that the beginning work in process inventory, subtract out our ending, and we come up with our cost of goods manufactured for the month. This is a very important statement. You will see that statement over and over again. Cost of goods manufactured, labor, materials, overhead, beginning and ending inventory. Think about it. It makes sense. It's something we're going to use. You say, well, how are we going to use it? Well, think about our cost of goods sold statement. In our financial section of this course, we talked about the fact that you take sales, you subtract out cost of goods sold, and you get gross profit. Well, we have to compute that cost of goods sold. If we're just purchasing stuff, we take our beginning inventory, we add what we bought, that tells us what's available, it's either still there or we sold it. It's a little bit different in a manufacturing firm because we have to account for the fact that we've manufactured more goods and we had some goods in some goods in our beginning finished goods inventory and some goods we've sold. So if we're looking at a cost of goods sold statement for a production company, we're going to take this basic cost of goods sold formula. Beginning inventory plus cost of goods manufactured gives you what's available for sale. Subtract out our ending inventory, and that'll give us cost of goods sold. Remember that second line, instead of purchases, is going to be our cost of goods manufactured. We computed cost of goods manufactured in the previous statement that I showed you, where we did the materials, labor, overhead, and adjusted for beginning and ending inventory. So the cost of goods sold statement is a little bit different for a manufacturing firm than it is for a retail firm. Just in that one line, instead of purchases, it's cost of goods manufactured, which we have to compute internally. So we have three things in. We have overhead, materials, labor. We come up with a cost of goods manufactured. We move that into our cost of goods sold. Our cost of goods sold then moves into our income statement. Think about our income statement. We have sales minus cost of goods sold gives us gross profit, just like we had before. We subtract out our general selling and administrative expenses, then our interest expense, and then our taxes to get net income. So the income statement hasn't really changed. It's how we compute cost of goods sold using cost of goods manufactured. So it's not much different from what you've seen before. Let's talk a little bit about activity-based costing. Activity-based costing is often called ABC accounting. The reason this has become so important in accounting systems is that the way we have taken our production facilities and used so much technology and so much computer-based production that our overhead is significant compared to our materials and our labor. Somehow we have to track our overhead a little bit better than we were doing in the past when we were labor dependent and materials dependent. So what we've had to do is find out the cost drivers, in other words, what causes these costs and overhead. And we call that ABC costing. Activity-based costing. What activity causes these costs? In your book on page 474, there's a very good description of activity-based costing. It takes you through the steps that are involved in a production process and looks at what might cause those costs. Using those costs in our total cost, we can find a cost per driver. In other words, a cost for every machine hour we use, a cost for every piece of equipment that we redo. So we have what we now call cost drivers. You're going to hear ABC costing quite a bit in the real world. That's because, again, our technology is such that we have a lot of overhead. Companies want to know what's causing that overhead, and it takes a lot of time and a lot of effort for a company to sit down and figure this out. But once they do, they have a much better understanding of where their overhead costs are and how they can cut the costs of producing a product. So you will want to spend some time looking at that ABC method, because you may run into it in the real world when you start exploring what's making our overhead go up so high. It's the technology, it's probably the new uses of computers for production facilities rather than labor and materials like we had before. So let's apply some of what we've learned. Now remember, we talked about overhead, we talked about cost of goods manufactured, cost of goods sold, and then finally just touched on ABC, just so that you're familiar with the concept. So let's look at our textbook and let's look at problem 8. Problem 8 is in your book at the bottom of page 482. It talks about product costing for manufacturing overhead. You have a company here that makes women's gloves. Their manufacturing overhead is assigned on the basis of machine hours. So for every machine hour they run, they assign some overhead to their products. For 2004, it was estimated that manufacturing overhead would be $359,520. So they went through and accumulated all their costs for overhead, electricity, depreciation, and so on, and came up with that estimate. They also estimate that they're going to use the machines 21,400 hours. So in Part A, they ask you to calculate the predetermined overhead application rate that's going to be used for making these gloves. Well, all you do is simply take your total estimated cost, $359,520, divide that by the number of machine hours, 21,400, and you find that for every hour they run the machine, there's going to be $16.80 worth of overhead. If you know that, then in Part B, during August, 3,900 pairs of gloves were made, raw materials of $62.40 were used, direct labor costs of $91.65 were used, and a total of 780 machine hours were worked during August. Calculate the cost of the gloves. There are 3 costs to any product: materials, labor, and overhead. They give you the materials at $62.40. They give you the labor at $91.65, but you have to compute the overhead. Now in Part A, you figured it was $16.80 per hour. They tell you that you ran the machine 780 hours. So if you take 780 times 1680, you get a total overhead of $13,104. If you add those 3 costs, labor, material, and overhead, you get the total cost of making a product. In this case, it's $28,509. That's for all the gloves. Now you've got to remember that they made 3,900 sets of gloves. These are pairs of gloves. So if you take that $28,509 and divide it by the 3,900 pairs of gloves they made, each pair of glove costs them $7.31 to make. They're obviously not going to sell the gloves for $7.31. That's their cost. They can use their cost then to come up with a selling price. Some companies use a 50% markup, some 100. Just depends on the company's competition and other factors. But they have to know what it cost them to make that product before they can set their selling price. In this case, $7.31. In Part C, it asks you to figure the ending inventory and cost of goods sold. If you assume there were 1,050 pairs of gloves in ending inventory, you simply take your cost per pair of glove, which we said was $7.31, multiply that by the 1,050 gloves in ending inventory to get $76.75.50, and then your cost of goods sold would be the $28.50 that you sold times the $7.31 cost for $20,833.50. So that's how you do overhead application. Estimated overhead divided by the driver. Well, let's do one more like that. Let's look at problem 10 in your textbook. Problem 10 is about the middle of page 483. What you have here is a company that makes desk accessories. Their manufacturing overhead applied to production is done on the basis of direct labor hours. During the first month of their fiscal year, $56,520 of manufacturing overhead was applied to work in process using some application rate of $6 per direct labor hour. So they want to know how many hours of labor were used. What they've done is twist the question for you. Instead of estimated overhead and driver to get an application rate, they're taking estimated overhead and the rate, and you have to figure the driver. So it's just a math problem. Something divided into $56,520 is going to give you $6. So if you solve that algebraically, you find out that your number of hours is 9,420. Okay, they didn't, in Part B, say actual manufacturing overhead costs incurred in March total 49,340. Calculate the amount of over or under applied overhead. Well, they applied $56,520. That's given. The actual overhead is given at $49,340. So if you look at that, they applied too much overhead. There's $7,180 of too much overhead applied to the cost. That's because their costs were less than were estimated, and they worked more hours than they expected. So there's going to be a difference between their estimated overhead and their actual overhead. So those two problems are good problems dealing with overhead. Let's look now at problem 19, which changes gears a little bit, and let's talk about cost of goods manufactured and cost of goods sold. In problem 19, at the top of page 487, you have some information about the raw materials, direct labor, and so on, the cost of running a company for November. And they tell you how many products were manufactured and how many were sold. They have no inventory, beginning or ending. So they ask you to calculate cost of goods manufactured. So think about your cost of goods manufactured statement. Materials, labor, and overhead, plus beginning inventory minus ending inventory for work in process. So if you look on the slide here, you simply pull the numbers off of the data. They give you raw materials at $33,100. They give you direct labor at $65,200. They give you the manufacturing overhead of $44,800. So your total costs were $143,100. To make this problem easy, there was no beginning or ending work in process, so you have two zeros there. So your cost of goods manufactured was $143,100. If you wanted to find out how much per unit, you simply take the total cost of $143,100 and divide it by the number of units you made, which was 5,300. You get $27 per unit. Now, if you know cost of goods manufactured there is $143,100, you're going to plug that into your cost of goods sold formula. You take your beginning inventory, you add your cost of goods manufactured, subtract out your inventory, that'll tell you cost of goods sold. So if you look here on the screen, your sales were $244,800, your cost of goods sold were $129,600, so your gross profit is $115,200. You had selling, general, and administrative expenses, interest expenses, and taxes, so your net income then is $42,000. That problem is a good process for you to practice going through and doing a cost of goods manufactured and an income statement including cost of goods sold. Let's do one more. Let's look at problem 24. I want to get you started on it and let you finish it. Problem 24 is towards the bottom of page 489 of your textbook. And you have a company that uses a absorption system for accumulating product costs. Absorption just means they use all their costs. They give you some data, raw materials, direct labor, etc. They give you the inventory for raw materials, work in process, and finished goods. The first thing they ask you to do is to calculate the predetermined fixed manufacturing overhead and explain how it's going to be used. Well, if you're going to do that, what you're going to have to do is figure out the total overhead estimated cost. And if you look in your book there, they give you the estimated cost. of $312. They then give you the machine hours is 96, so it comes up with a $3.25 manufacturing overhead cost. They ask you to graph it. Well, you could see in your problem there, it's just a diagonal line and a vertical line. They want you to figure in Part C the variable manufacturing overhead. So again, you look back and figure your variable manufacturing is applied on the basis of $6 per direct labor hour. So all you do is figure out it's going to be 0 if you have 0 production. It's going to go up $6 for every unit you make, so it'll be a diagonal line. Finally, in Part D, they ask you to do a T account to calculate raw materials. I didn't quite do a T account. I simply took the beginning inventory plus purchases, told us what was available, subtracted out what was used, and that gave us our ending inventory. So if you look at those numbers, you're given the beginning inventory and raw materials, you're given the purchases. You can figure out what's available. They tell you the ending inventory, so you know you used $252,000 worth of raw materials. If you're looking at your part, what would that be, E, they're asking you to calculate variable manufacturing overhead applied. Could the variable overhead differ from the actual amount? If so, give some examples. Obviously, yes, it could be different. You simply take your 26,250 direct labor hours, multiply that by $6 per direct labor hour, get $157,500. Finally, in Part F, they ask you to calculate the fixed manufacturing overhead applied to work in process. You simply take your $3.25 per hour, multiply that by your 88,000 hours, and you get a total of $286,000. Finally, in the last two parts, they ask you to do T accounts. You can either do T accounts or what I did in your handout there was simply to use the formula that we've been using throughout the course. Beginning plus purchases gives you ending, so on. So you may want to look at it as a T account, you may want to look at it as a formula. Either way, you should get the same answers. So what we've done in this particular module is to look at overhead, how we apply it, how it can be different from actual overhead, cost of goods manufactured, how we calculate it, cost of goods sold, how it's changed just a little bit for a production firm. We explained a little bit of what ABC costing relates to, and then finally we'll work some problems in all of those areas. So that finishes up Chapter 13. In the next module, we'll start on Chapter 14.